Sugar daddy and investment life bring you freedom of financial.
Hey everyone, I'm your New York Tea Daddy, and today we're diving into yesterday's November 1st wild ride on the US markets. High open, low close. Yep, you guessed it, I saw it coming. The stock market's gotten a bit overheated right now, hasn't it? Don't worry, I'll break it down step by step. Why this 1-year truce in the US-China trade deal looks like good news on the surface, but is really just buying time with some massive pitfalls underneath. Let's roll. First off, let's talk about that Trump-Xi summit at the Busan APEC meeting. On the technical side, no big breakthroughs, just like I predicted, a classic delay tactic. On rare earth exports, China says they'll temporarily open it up, but with monthly reviews and approvals for sales, and they'll tighten it again when needed. The US pulling back on shipping fees and symbolically cutting tariffs by 10%. But don't get too excited. The original hikes were only effectively around 30% anyway, and this 10% cut isn't full. It's still hovering at 30%. Impact? Barely noticeable. To give Trump some face, China will keep buying soybeans, even committing to 12 million metric tons through January and 25 million tons annually for the next 3 years. They're trying to play nice. Sounds like reconciliation? Nah. This is straight out of the Thucydides trap playbook. Two superpowers pretending to cool off while secretly loading up ammo for the next big clash. Remember the 2019 G20 Osaka summit? Same vibe. Short-term US stocks popped around 2-3% on the news, but lingering trade tensions kept volatility high through Q4, with the S&P 500 ending the year up 9% despite the whipsaws. If South China Sea or Taiwan tensions flare up now, rare earth supply cuts could jack up tech costs by 15-20% and Nvidia's margins sliced in half for sure. Now, onto the stock surge. Why is it so unreasonable? From August to now, US markets are up about 9 to 10%, with a modest uptick in September, but then October pushes higher, around 2.3% for the S&P and 4.7% for the Nasdaq, folks. But back in August, US-China relations weren't even that tense. Earnings season rolls around, and what's the deal? Amazon's cloud business is on fire. Q3 revenue at $180 billion, up roughly 13%. AWS Cloud hit $33 billion, up 20%. Google's ads are solid too. Total revenue $102.3 billion, up 16%. With search and YouTube both in double-digit growth. YouTube ads topping $10 billion for the first time. But Meta's ad revenue, around $50 billion, beating expectations, yet a $16 billion one-time tax charge sent shares down 9% that day. So what's fueling the rally? Pure sentiment and hot money. It's like the 2021 SPAC bubble. Nasdaq up about 7% in October, then crashed over 20% into early 2022. Right now, the VIX Fear Index is at a relatively low 17, and November 1st's high open low close with Nasdaq down around 1%. That's the profit-taking warning shot. The real headaches are kicking in with diverging earnings. Nvidia's China business is tanking. Q3 China revenue expected to drop sharply, down to about 6% of total sales from 13% last year, thanks to ongoing export controls, with an $8 billion hit already baked in. Their upcoming report, expected mid-November, is going to be a bombshell. Google's European services, hamstrung by taxes, a fresh €2.95 billion GDPR fine for ad tech abuses, squeezing ad revenue by an estimated 2 to 3%, and back home in the US, inflation at 3%, above the Fed's 2% target, with tons of companies forecasting 5% revenue drops in Q4. Trade spats plus inflation. Who can hold up? Finally, the macro bombshell. Fed rate cut doubts for December. They just cut 25 basis points to 3.75 to 4% on October 29th, AA 10-2 vote. But Powell's saying December's far from certain and market odds are around 70%. Unemployment at 4.2%. Q3 GDP only plus 3.9%. The real economy's heading south, so hot money's bound to cool off. My call. Stocks pull back 10% or so back to August levels, maybe a tad lower depending on sentiment. Like the volatile December 2022 after the Fed's hawkish pivot, S&P dipped about 5% intraday swings amid broader yearly declines. If it repeats now, S&P from 6,822 to about 6,140, a 10% bloodbath, with tech leading the 15% drop and VIX spiking to 25. Buckle up. Wrapping up, this deal's fake good news, real stall tactic, markets overheated, watch Nvidia's report, and the Fed meeting short-term, long-term dodge tech, pivot to defensives like consumer staples. What do you think, friends? Bullish or cautious like me? Drop a comment, smash that like, subscribe, and hit the bell next vid. We're unpacking Nvidia's Black Swan. Catch you in the markets. Bye.
Please subscribe and follow New York Daddy Investment.